Well, good morning, everyone. And it's nice to see such a good turnout to a breakfast on such a cold morning. It shows how everyone is curious about the subject matter today, and quite understandably so. So what the five of us are going to try and do today is we're going to talk a little bit about why hedging matters. And if you think about where the world is right at the moment and the turmoil and the decisions that you as corporates have to make on a daily, weekly, monthly, yearly basis in this volatile time, it couldn't be more pertinent to be having these type of conversations. The purpose, so let me just give you a little bit of a background here. So the purpose of today is that we've got the panel that are from various sectors as well as have various experiences and skills. And we're going to make today more conversational, and each member is going to talk about their specific, what they do specifically at their organizations. We've got, and I'll introduce the panel right now. We've got George, who's George Glynos, who is a founder and director of ETM Analytics and a well-known economist in South Africa. I'm pretty sure most of you at some point over the last few years have been to a presentation or heard George talk or read a piece that George has put together. And there isn't anyone really better than George to be engaging on this topic with us. We'll kick off today with George doing a presentation on the macro environment that we find ourselves in and create the landscape around what all of you are facing on a day-to-day basis, and maybe give us his thoughts and insights into what the forward picture looks like. But the truth of it is that the forward picture is exceptionally hard to predict or even to quantify given the sensitivity that these markets are facing with the day-to-day rhetoric that we hear and the positioning that we see coming from the political powers in the world right at the moment. So George is going to give us about a half an hour presentation, and that's a great way to kick off and to start it. We then have Wilfred Skhosana. Wilfred is currently the treasurer of Thungela Resources. It's South Africa's #1 biggest coal exporter. And we've been quite deliberate as to how we've put the panel together. Wilfred and Thungela are real active hedgers of their foreign revenue. And they are one of the more dynamic hedgers in the South African market with regards to their revenue. And it's going to be very useful for Wilfred to unpack the instruments they use, the thinking behind why they hedge, what they're hedging, policy, etc. And Wilfred's going to go into that. Wilfred comes with years of experience. He spent a lot of time in Anglo-American, in treasury and financial roles, and he's now got the big responsibility of managing the country's biggest coal exporter revenues. What Wilfred is also going to touch on, because although we've got exporters on the panel, we also want to talk a little bit about what's going on the import side of, on the expense side of the exposures that companies are facing. And one of the biggest exposures that Thungela do have right at the moment is their diesel expenditure. And it'll be very useful if you could talk to us a little bit about diesel. My understanding, and can be corrected, Joe, is that you don't manage that. You only manage your revenue side of it. But he can go into the detail as to why, because I think it's very interesting. So we've got an exporter that hedges. Then next to him, we've got Riaan. Riaan is recently just left DRD, but he was the CFO for the last 11 years, I think, if that's correct, with oversight of treasury. Riaan also comes with years of experience. Prior to DRD, he spent 17 years in the audit community, having worked predominantly in doing audit and IFRS, etc., with mining houses. So he comes with a truckload of mining experience. What he's going to talk about, though, is DRD doesn't do any hedging at all. They don't hedge any revenues. They don't hedge any input expenses, etc. So we've got two contradictory, two exporters to compare and unpack and understand why. And the intention here is, as I said, it's conversational. So whether there are questions or comments that are from the floor or from any of the panelists here, we might well be challenging on why the stance you've taken and is it the right stance. And that's to both of our corporate treasury people here. And then at the end there, and this for me is so pertinent, we got Kevin Hoff, who is a partner and head of the financial services team at BDO. And so when one talks hedging, I know, having engaged with most of you, a lot of you over the years, one of the biggest challenges when talking about hedging, putting various instruments on the table, unpacking, whether it's the right or wrong instrument, does it actually work for your financial risk, how does it impact your economic risk, etc. One of the sticking points always is accounting and the hedge accounting. And Kev comes with plenty experience. It's one of his passions. When we were preparing for today, Kev was telling me how he is going to demystify accounting for us today. And he actually put a real positive spin on it. And he said that what we have seen is we've seen a real evolution in accounting rules and principles and the actual application of it over the last 5 or so years. He's been very part of that, and so he's going to share those insights. I think it is critical. I think over the years we saw far too often companies not manage the risk with the right instrument because they were uncomfortable about the accounting of it. And accounting ended up, you made a financial market management call from an accounting point of view, and it ended up having quite a significant economic impact, negative economic impact on the business over the years. So Kev, there's a lot for you to chat about. A little bit of background on Kev. Kev's been in the market about 20 odd years, shared between KPMG and BDO. He's passionate about the topic of accounting, the topic of hedge accounting, fair value accounting, etc. He's represented on 2 working committees. He's positioned on the SICA banking forum with regards to fair value accounting, etc. And he's also part of SARB's current working committee on working party on the implementation of Zionia. So really, a lot of insights can be gained from you. So we're hoping to have a good debate here. We're hoping to have good questions from the floor. We're hoping to be able to challenge each other here. And hopefully you will all be able to go away with a bit of insight, a bit of food for thought, and go back to review your own policies, maybe challenge some of it, put your hands up, say let's have some people come in and let's talk a bit more about it. I think that if we could achieve some of that, I think we would have had a good session this morning. So without any further delays, let's hand over to George. Give us some insights, George. Look, the truth of it is if George got it right constantly, we wouldn't have to be having this hedging conversation. Because having spent as long as I have in the market, the one thing I know is it's almost impossible to predict, to forecast what's really going to happen, which is why hedging is so critical and having a consistent hedging approach. Okay, George, over to you.
No, thanks, Peter. Morning, everyone. I prefer to stand while I'm presenting, if that's okay, and Is it okay with the camera? Okay, good stuff. Morning, everyone. Great to be with you. Lovely to be in Joburg, although, geez, you could have picked a warmer day for us. But lovely to be here. Nice to see some familiar faces. Good to be discussing some interesting topics. Geez, I'm not short of topics to talk about at the moment. And I think that's the purpose of my chat today. So my chat today is really to paint a little bit of context against which we can have some of these hedging discussions and talk about what can and can't be done. What I prefer to do, as Peter quite rightly pointed out, I don't have a crystal ball. Shock of all shocks. I don't have a crystal ball. I don't know what's going to happen next week, never mind next month or next year. But what we do know is that there are a lot of very interesting developments that do not unfold in a blink of an eye, that don't reverse equally quickly. And so you do get a little bit of lead time into how some of these big geopolitical forces unfold. So the purpose of my job today is to paint some of that context for you, and in the hope that we have a semi-intelligent discussion about how we go around, about protecting our businesses. So I guess the obvious point to start right now is to talk about what's going on in the world's hotspot, which is the Strait of Hormuz. And you will have noticed from the chart on the left that there's been a fairly significant drop-off in activity, ships coming into and out of the Gulf. So there have been some attempts to try and get some ships through. They switch off their transponders. They do all sorts of interesting things to sneak out, but the blockade is working pretty well on both sides. The Iranians have scared the ship owners enough to stop them from wanting to put their ships at risk, and the US has done the same to Iran. The net result is that we've got a trickle at best. If we get 5 or 6 ships through a strait on a day, that's a really good day. Compare that to what it used to be in the days before the war, and you were talking, in some cases, north of 100. So we have shifted a long way, and of course it's created tremendous stress in certain markets, not just the shipping markets, but obviously the oil markets as well. I had a look on Polymarket just to get an updated sense on when people thought that there would be a permanent peace deal, and it's been quite interesting to watch how people are betting on this outcome. And a week or two ago, all of those dates would have been brought forward. So the percentage probabilities of a quick deal was much higher in the near dates. All of a sudden, I looked at it the day before yesterday, and you're only getting to 64% probability by December. Now that's problematic. Already there's been a significant shift in the way that the market is interpreting what's going on at the moment. They're seeing this as a bit of a stalemate, and that stalemate takes the form of, in economics, we like to talk about these negotiating tactics as game theory. Game theory being two positions, opposing positions, looking to negotiate the best deal for themselves, but ultimately having to come to terms with the idea that they may have to choose the second best or even the third best option just to get a deal over the line. So let's give you a little bit of context as to what the market is anticipating. Well, at the moment, the market is still looking for a deal to take place. We can see that in the oil futures market, and we can see that the oil's market is still in backwardation. In other words, the futures prices are well below current spot. We can also see it in some of these geopolitical risk indices that we like to look at from time to time. That's unwinding a little bit. There is an expectation, undoubtedly, that there is going to be a deal. And I think the way that people are looking at this is that they're trying to assess how deep the pain sits for both sides. And we'll unpack that in a bit. Let's give you a little bit of perspective on why there might be strong incentives on both sides to get a deal done. Well, on the left-hand side, you can see what's happening to Trump's popularity. It's not doing particularly well. And so when you have a look at the odds of a Democrat clean sweep come the midterm elections, likely to be in November this year, it's risen all the way up to nearly 50%. That's a very significant change from where we were just in October, November last year. So the odds of that happening have nearly doubled. Now, why is that significant? Well, it's significant because not only does Trump not want the Democrats taking control of both the House and the Senate, because it effectively renders him a bit of a lame duck for the rest of his presidency, but it also increases the risk of him being impeached. So he knows that, and he would want to try and find an off-ramp to this as quickly as possible. That is not the legacy that he would like to leave at the end of his presidency. So on that front, there's a political cost. There are a few others that I will unpack as this presentation unfolds. On the Iranian side, try and get Iranian data at the moment. It's not very easy. But what we can look at is their currency, and their currency's taken a hell of a hammering. When I say hell of a hammering, I'm talking about a virtual 3,000% depreciation. If you were wondering what that might look like in terms of impact on the economy, you're talking about a huge bout of inflation. You're talking about households that are not going to be able to pay bills. You're talking about an economy that's going to create a deep recession. It's an interesting perspective, this, because quite often what we have found is that regime change happens sometimes through more subtle means. You don't always have to bomb your opponent to oblivion, to use one of Trump's terms. You can force them to surrender in another way, and that could be through economic means, through economic pressures. And we believe that this is what they are up to at the moment. You've heard about them potentially taking over Karg Island. Karg Island processes 90% of Iran's crude into refined fuels. They've blocked the Strait of Hormuz, so Iranian ships aren't coming out. There's a lot of pressure building. A lesser-known fact is that Iran is also running out of storage capacity. And the reason that's important is because, well, when you're producing as much oil as Iran produces, you need to store it somewhere, or you're going to have to shut down your pumping facility, your oil mine, so to speak. Switching something like that back on again is not a flick of a switch. It's not about just instantly, oh, well, now we're moving again, so we can just restart this pumping process. It takes time. And as a result of that, we know that the Iranian economy is going to come under significant pressure because, after all, it is an oil-based economy. So if oil's not taking place, if they're not selling any of the stuff, if they've got a currency falling to pieces, think back to the days of the Arab Spring, and you'll understand how economic pressures ultimately can force a country into a different regime or a different path altogether. Even if a peace deal was achieved today, so let's say we opened up the news wires, opened up our websites, and great news, they've decided to come together, you need to appreciate that it doesn't just all get better overnight. Some of the forward-looking markets will improve. Naturally, you would expect that. But on the ground, operationally, there's some realities that you can't get away from. The first is that it doesn't take a week or a day, a couple of days to offload a tanker. It takes roughly a month. If you have a look at a map of the amount of tankers that are sitting in the Gulf, what you'll find is you're talking about a significant number that now have to leave and that have to dock somewhere. So imagine, it's a race to the first port, and once you get there, there's going to be a queue of tankers waiting to offload, because that's ultimately where they're going to be. That's what they're going to be headed to offload and rebuild inventories and all of that stuff. So you're not just talking about a month to offload. You're talking about the trip to the port, and then you're talking about the waiting times at the ports, which is obviously going to be fairly significant. There's also been the movement of ships to different shipping routes to try and mitigate the effects of what's happening in the Straits of Hormuz. So many of the ships have been diverted to other regions of the world. In many instances, they've headed off to the US. Why? Because the US has some spare capacity, especially now that it's refining a lot of Venezuelan crude. And so to get those ships back to the Middle East is going to take them roughly 3 months to do. So you've got delays that are coming through all over the place. On top of it, you've got on-land storage, which is now reaching capacity. You can't produce to the full extent that you would like to produce. A lot of these producers are producing at a bare minimum so that they can just keep a lot of these pumping facilities alive. Is my sound? Oh, no, it's back. So I can keep these pumping facilities alive, but they're running out of spare capacity to store the stuff. So you've got to unload it off the on-land storage facility before you get to start filling it back up again. And once again, there have been some facilities that have not only been damaged but shut down. Those are going to take a while to bring back up. So all through that time, what's happening at the moment is that we're drawing down on strategic reserves. We're drawing down on reserves all over the place. Those reserves at this point in time are sufficient. They're supplying the world with enough crude and distilled fuels, refined fuels, but that doesn't last forever. What we are finding is that there's going to be a significant impact on overall costs associated with all of that, drawing down on those inventories and restocking them again at a point in time when things start to normalize. But there are other costs associated with what's going on at the moment and some lesser known costs, such as shipping costs. So now we've seen, because so many ships have been trapped in the Gulf, there's obviously fewer other ships to go around, and the cost of these VLCCs, these very large crude containers, these have increased in price naturally. So you're not just talking about an increase in the price of oil and refined fuels, you're also talking about the increase in the price of logistics, such as the rising cost of shipping. That's not to mention the fuel that, of course, these ships utilize, which in itself has also gone up. So to put all of this oil crisis in context, it's about 3 or 4 times larger than anything that we've seen before. This is a very significant crisis. If it goes on for much longer, we've got a serious problem on our hands. Reserve buffers, as I said, the supply is gradually winding down. We've lost something in the order of about 1.2 billion barrels of cumulative storage. That will be the case by the end of June. There was roughly 15 to 17 million barrels per day exiting the Strait of Hormuz. There have been some mitigating factors against that. Saudi can still push out 5 through a pipeline, the UAE another 1.5. There's been increase in production in the US as well as Venezuela. There's been a strategic reserve. So we've kind of made up the difference, but there's been, at least 1.2. Some estimates have been almost double that in the amount of cumulative storage that's been lost through this crisis. So there's going to be a lot to make up. And the obvious conclusion is that, well, if this goes on for too long and prices rise too high, that recessionary conditions become more probable. We hope we don't get there, but on that point, it's maybe worthwhile just paying attention to what the world looked like before the crisis. So before the world entered this war scenario and oil prices spiked like they did, where were we in the broader scheme of things? So we like to use a monetary variable which we call the dollar liquidity cycle, to give us a very broad read on how the global economy was functioning. Think of this as a tidal chart. When the tide comes in, all assets float equally. When the tide comes back out again, you start to see which ones are a little more vulnerable than others. And there's a bit of a distortionary effect that's visible in the latest data, so it's not as bad as what it looks over here. What you did have was a huge spike, and we're still working through COVID-related data, if you can believe that. But in the onset of the pandemic, the Federal Reserve, along with a few other central banks, pumped in trillions upon trillions of dollars of liquidity into the global economy. This is the Fed specifically, so you're talking about $5 trillion. That took place in the space of just 18 months. In the years that followed, they conducted some quantitative tightening. They drained at least $3 trillion back out of the system. And so on a growth basis, which is what this is, you suddenly raised your base, and so your base now sort of looks like it's collapsing. So it's not as bad as what this chart ultimately looks. It reflects a bit of a normalization. However, it is fair to say that the tide has been coming out. So the tide coming out means that, economically speaking, the credit cycle is not as strong as it used to be. And I think that's the point of this chart. Just bear that in mind. The credit cycle was not as strong as it used to be. The other incentive that Trump's going to have to want to get rid of this problem as soon as possible and to find some sort of a solution is that the US hasn't as yet experienced the full brunt of the inflation impact. They've seen it at the pump prices, but until it filters through the rest of the economy, the households aren't going to experience the full impact of what's happened to the extent that it results in a further kickback on the political side. And we know that we're just a month or two away from inflation spiking in the US as well. That's not just a US problem. Of course, it's a global problem. One could argue that the US is probably going to experience this crisis a lot less violently than many of us, South Africa included. So this is something that we need to take into consideration, primarily because we've got a new Fed governor coming in, and the new Fed governor was tasked with reducing interest rates. Well, I think he's going to have his work cut out for him. And the market knows it, and together with a fiscal problem that a lot of these big economies are suffering with at the moment, what's happened is the rate cuts, as decided on by the central banks, have not translated into reduction in bond yields. And the reason why that's important is because many of the lending that takes place in these big economies benchmarks off the bond, not necessarily purely off the central bank rate. And so if you have a look at these central banks, they've all three cut rates, but have a look at the corresponding bond yields in all three cases have actually gone up. In other words, if the previous chart where we were talking about the tighter credit cycle, if we were looking for some alleviation, it doesn't look like it's happening anytime soon, especially with many of these governments up to their eyeballs with poor fiscal policy and borrowing hand over fist. So they haven't been able to rein in their budget deficits. There is fiscal risk that's being priced into these bonds. And it's a big unknown at this point in time whether the central banks are going to have to, at some point, step back in with a form of quantitative easing to try and calm these bond yields, bring them back down again so as to avoid an outright correction in other asset markets like equities, which at the moment are still doing quite well. Bringing that back to South Africa, the chart on the left is something that we're experiencing at the moment. So that's what your diesel and your petrol prices are looking like at this stage of the game. And the table on the right, it might be a little bit small for you guys to see, but we try to calibrate a combination of the oil price together with the dollar rand to give you a sense of what that might do to domestic inflation. And that's important because it obviously feeds into what's going to happen to our domestic interest rates, and that has implications for the rand. So let's just go through. The upside is probably your base case scenario where you've got $100 per barrel and 17 rand to the dollar as your currency. That's sort of where we're sitting at the moment. That's where we're talking, and we're talking about a projection of inflation that sits around the 4.7 to 4.9% mark by around about June this year. So that's a fairly strong increase in inflation that we obviously are going to experience. It gets a little more acute should we have a more base case scenario where we still have $100 per barrel, but we have a dollar rand at 17.5. Now, 17.5 is a fair way away from where we are right now. But you guys know as well as I do that rand can move 30 cents in a day, no problem. This is less than a week away from happening if some bad news hits. And so we are, at this point in time, still painting a cautionary tale for our clients, and I'm going to show you a few reasons why that would be the case. But we, at this point in time, are fearing that there are risks to the rand. We've been bullish rand for quite a long time. We've had to reassess that for the purposes of today, but for the reasons related to what's happening in the Middle East. So under the base case scenario there, you're talking about an inflation rate that's jumping to closer to 5.5% by around June. Now, when you've just had a central bank that's pushed really hard to target 3% inflation, you can imagine the implication of that. And so it hasn't gone unnoticed to us that when we're looking at the rand, the things that we import the most landed up at the top of this table, being your fuels, your refined fuels, all the imported stuff that we need to keep this economy going has unfortunately experienced huge increases in prices, and the stuff that we export through the course of the past month have experienced decreases in prices. And the obvious implication of that is that it erodes your terms of trade. I'll get to that in a second, but for the time being, what this ultimately means is that the risks are starting to stack up against the rand, starting to stack up against South Africa. And so it's not surprising for us to see, and in fact, when I looked at the FRA markets this morning, the number looked a little bit worse than this. So as I looked at the 9 by 12, it was pricing in something in the order of about 91 basis points worth of hikes by year end or beginning of next year. So you're talking about at least 3 rate hikes this year, possibly even a 4th, depending on the outcome of what's happening internationally. If I have a look at domestic versus the US being the blue, so long as it's below that break even, they're pricing in rate cuts. Anything above that break even is pointing to rate hikes. Quite clearly, the US might be flat, but we're pricing in close on 1% worth of rate hikes. And so we can expect to see the spread between South African rates and US rates increasing. The 3 issues or the 3 drivers that we focused on at the moment that gives us a sense of how rand might behave is, of course, the oil price, and the two have been moving quite closely together since the start of the war. And so we have to focus our attentions on what's happening to oil prices. But as that table showed, the terms of trade are the things that are really bothering me. So we had a nice correlation between the performance of the rand and terms of trade. Those terms of trade have fallen off very, very sharply. The implication over here is that rand needs to weaken. Up until now, rand has proved impressively resilient. It's been given the benefit of the doubt. I wonder how much longer that's going to be the case, and I think we need to carefully think about what the picture might look like if this war doesn't end soon, if we do get oil prices that continue to rise for some of the reasons that I stated a little bit earlier. It takes time for these things to come back on stream quickly. All of that ultimately rolls up into how foreigners might perceive the value in South Africa's bonds. So South African bond yields have started to tick up recently. They've taken some of their direction from what's happened in US treasuries, but they're also starting to focus on the reality that inflation is rising. And that perhaps the bond market had run really, really hard for most of the past year and is due to go through a correction. I can tell you that a dollar rand at 17.5, 18.5 to the dollar is likely to push these bond yields a little bit north. And the result of that is obviously more pressure on the rand. So what do we have here? We've got a picture where if some bad news comes out of the Middle East, or if it drags on long enough that we start talking about the real risk of scarcity of fuel in South Africa, that could be a catalyst for Iran to come under a bit of pressure right now. And so the risks are gradually starting to tilt against the Rand being as resilient as it has been up until now. We build our own carry attractiveness index, which takes 5 different variables into consideration, including interest rate spreads. We look at current account viability. We look at volatility. We look at a few variables to give us a sense of how attractive South African Rand might be, or South African Rand assets might be to foreigners. And what we found is that obviously the one big detractor has been the terms of trade. Our carry attractiveness has fallen off quite sharply. That's the green line. The closer we compress to the EM and the DM average, the less South Africa stands out as an obvious place to park your money. It certainly wasn't the case a few months back when we stood out as a country that stood to give you a great return on carry. That's not the case anymore. If I have a look at our Rand sentiment indicator, something derived not through a survey, but through looking at how the options market is trading. So the trading behavior in the options market, looking at risk reversals, looking at the shape and the picture of the volatility surface, to give us a sense of whether the professional market is hedging aggressively against Rand weakness or not. That gives us a sense of whether they're optimistic or not. Well, yeah, that indicator fell off very, very sharply, as you can see. The high-frequency version has bounced back a little more recently, but we still have a path to follow. There's some path dependency, and that's very much related to the mechanical hedging behavior that's been conducted through the course of the past couple of months, which will manifest in tilting the pressures in the Rand one way or another. There's roughly between a 55 and 60% correlation between the Rand sentiment indicator and the way that the Rand behaves. So we do take this indicator seriously, and it too, completely coincidentally, is telling us that Rand is at this point in time looking a little more vulnerable. The one factor that has shielded South Africa so far has been the fact that the dollar itself has been somewhat overvalued. So when we have a look at this long-term chart going all the way back to the 70s, you can see where the dollar's been sitting compared to previous peaks. And you would be reluctant to be heading into a market this strong with a very big, long position. At this point in time, if I have a look at the futures markets, if I have a look at speculative positioning, the general bias in the market is shifting against the dollar. There's been some real big geopolitical forces that sit in the background. That doesn't offset all the previous charts that I've shown you on Rand. Remember, those are far more short term. So any Rand volatility that we might experience as a result of what's going on in the Middle East and some of that fallout, that can happen in the next couple of months. These are sort of much longer term charts that we need to consider in that backdrop. But some of those geopolitical shifts that have happened have, of course, been the large central banks that have been rotating their treasury holdings away from the US. So they've been shifting their reserves away from holding US treasuries towards holding gold. Now, it's an interesting dynamic that unfolds, because the more you tend to find that they rotate out of US treasuries and US assets, the more the pressure tends to build on the dollar. And so the chart on the left-hand side gives you a sense on how much more aggressively these central banks are unwinding their positions at the moment. And this, what's been happening in the Middle East, what's happened in Venezuela, the sanctions that were imposed on Russia, for example, has a lot of the BRICS countries saying, well, we don't want to assist the US to weaponize the dollar against us any longer. We need to try and reduce their leverage over us. And so they're starting to shift away from holding US assets to the extent that they have been. The chart on the right just gives you a more short-term movement on how these central banks have been offloading. Say for a brief period where it increased more recently, it's back down again. So in terms of Rand performance, well, it's no longer a standout. We used to trade near the top of the performance bands, not so much anymore. Since the beginning of 2025, we're roughly mid-table, so not standing out particularly brilliantly. Even if I have a look at the chart on the right, 1 year, it's a similar sort of picture. So Rand not doing particularly well. And if I have a look at our valuation tools to give us a sense of whereabouts we find value or not in the Rand against the dollar, the euro, and the pound, I thought I'd introduce you to the way that we like to think of these things. So the way that we've plotted this is that it's a purely statistical method of looking at the Rand. We have focused on all the individual days give us a dollar Rand rate. And if you picture a bell curve where we plot all of these things, that bell curve is reflected in the 3 lines that you see, the 3 valuation lines. The core middle line, which is essentially, if you had to take one of these charts, cut it down the middle, what you would find is that middle line is the body of the bell curve, and that the lines on either side are the tails. So what we try and understand statistically is whether or not these movements in the dollar Rand are towards the tail of the distribution, of a typical distribution for the Rand over a 7-year period, or is it more towards the body of that distribution. And what we find with the dollar Rand is that it's effectively telling us we're in overbought territory. So Rand is expensive at these levels versus the dollar at this stage of the game needs to strengthen relative to the Rand, or the Rand needs to weaken relative to the dollar. The picture isn't the same against the euro and the pound. So it is quite possible that you get a bout of weakness in the Rand. According to the chart on the left, you could go all the way back to 18.5 and still be somewhere in the body of that bell curve distribution. So that would be pretty normal, actually. 18.5 to the dollar would not be anything to be particularly concerned about. The straight lines that follow, those are just what would happen if you had to utilize the forwards to hedge yourself going forward. Where would that put you? Well, on the dollar Rand, you would still be in the tail. So that should make you feel uncomfortable as an exporter. As an importer, you would be looking at this and clapping hands. This is a more ideal situation for you. As an exporter, not so much. In terms of euro Rand, it's telling us there's no great conviction one way or another against the pound. Better off for exporters than it is for importers. But I'm going to leave you with 2 charts. The last 2 charts of my presentation, just to give you a little bit of a perspective on a risk that I've identified, which does bother me. What this crisis has done, and it's done it for most countries around the world, but it's done it specifically for South Africa, and let's just focus on South Africa for now. What it's done is it has exposed South Africa's dependence and reliance on importation of critical refined fuels and crude from elsewhere. Now, we don't produce our own crude. I get that. So we have to import it. We're importing the bulk of our crude from Nigeria. But if you have a look at the chart on the left tells you where we get the bulk of our refined fuel. And if you're looking at Oman, you're looking at Saudi, you're looking at Bahrain, Kuwait, UAE, we're importing from the worst possible place on earth at the moment. Okay, we can't get this stuff out. India might be a bit of a saving grace for us, but this is a problem for South Africa. And being friendly with Iran doesn't help us. Doesn't help us because Iran can't get their stuff out, and the US is not going to let them get the stuff out. Furthermore, we're not best friends with the US at the moment either, so they're not going to go out of their way to do us any favors. So we have a problem on our hands with regards to refined fuels, and that's something that we need to keep perspective on, because if you had to ask me, identify one thing that could see Rand pop. What's that one thing? Well, that one thing could be our pump's starting to dry up if we don't get enough refined product into and around the countryside. Why that's a huge problem is because, well, we've, amongst other things, destructed our refining capacity in this country. And so we cannot refine anywhere near, even if we got the crude into the country and reduced our dependence on the Gulf, we do not have the refining capacity that we used to have. Some of it is because of weather. One of our refineries got shut down through flooding, which, okay, life happens. It's unfortunate. But some of it was due to South Africa's own mismanagement. The reality of the situation is that we're now more vulnerable than we should have been. We also went and sold our strategic reserves back in 2015 under Jumat Peterson. And so that in itself, we had something like 3 months worth of reserves. We now have 2 weeks. So it's an uncomfortable place to be, and I'm just raising it as a potential risk, because if this war drags on, and I don't know, what side of the bed Trump wakes up on tomorrow, and I don't know whether the IRGC decides to soften its stance or not, but the way things are looking right now is that this could drag on for longer than feels comfortable. And if that is the case, then I think we need to get our heads around the possibility that this becomes a reality. And so on that front, that gives perhaps a good segue into discussing perhaps what we need to do to prevent some of these risks from manifesting.
Thanks, George. Yeah, there are a lot of positives to take away from that, George? But you know what it does illustrate is there's a lot of risk, but there's no absolute clear-cut picture either. No. And what that says to you is, if you're managing exposure for a business, you can't sit on your hands and do nothing, because the risks are to both sides. And that's why this conversation is so important, because this is where the concept of hedging, and hedging, the way we've always seen hedging, is that you look at hedging to provide insurance, to provide flexibility and participation when you've got the market wrong. But you haven't had a sleepless night because you had that insurance. And I think it'd probably be a good time to cross to Wilfred now, because that's the kind of hedging that he's been doing at Thungela. And he can share a bit of what they do at Thungela about that. I've just got a couple of questions for you before we do, because I don't want to lose track. You mentioned a few points that you mentioned that I just wanted to understand. You talk about our terms of trade and how they are deteriorating. I'm curious to understand, what are you really referring to in terms of trade? Because you're saying that is a big risk to the exchange rate. All right. So I want you just to elaborate a little bit on that. And then I'm keen to, you talk about one of the fundamentals that you monitor is the risk reversals. And that gives you, and yes, that does give you a good gauge as to what the market is thinking about with regards to negative risk. And you start to see that in the risk reversals and the option market. And are we actually seeing that in the pricing? Because then that speaks to the hedging, because once you start to see that hedging, it starts to give you extra value when you start to once you see those risk reversals and the pop-up in the option market, that also starts to feed towards being able to achieve better hedging levels as well. And so would feed into Wilfred's thinking with regards to what he does at Thungela.
Yeah, so with regards to the terms of trade, it literally is a calculation of what you're importing versus what you're exporting. If the price of what you're importing is rising, and the price of what you're exporting is falling, your terms of trade are depreciating. So that will manifest in your trade accounts moving from a surplus position to a smaller surplus or to a deficit. What you ideally want, and what South Africa has had through most of the past year, has been a rising, improving terms of trade, because we've had a gold price that's done really well. And in fact, dare I say, over the past year and a bit, the platinum price has done even better than gold over that same sort of 1 year period. So we've had two big exporting elements of South Africa's trade account doing really, really well, and oil prices remained contained. We've had the opposite now. And so we've gone from a very supportive tailwind to a fairly strong headwind. And that's happened in a very short space of time. That's happened in the past 6-7 weeks. So that's happened fairly dramatically. In terms of the risk reversals, so when you have a look at those risk reversals, in fact, a week or so ago, they looked fairly extreme. They've normalized to some degree now, which kind of is reflected in that high-frequency version of the Rand sentiment indicator bouncing back up. But there were some very strong indications at that point that there might be a good opportunity in the options market to hedge yourself against the possibility of Rand weakening. I think that, and I haven't looked at the specifics of the options market this morning over the last couple of days, but I suspect that we've missed that boat. But the idea there is, if you can keep track of these things, then you are able to jump onto the opportunities. But I think Wilfred would probably be better placed to give you a real-life example of how that might unfold.
Excellent. Do you want to give us your update? Thanks, Wilfred.
Thanks, Peter, for transferring all the pressure. Good morning, everyone. So as Peter has already mentioned, I'll be touching briefly on why have you seen hedging revenues being useful for Thungela. I would certainly like to think for most commodity exporters. And also, why are we not actively playing in the input hedging space? And maybe the last point in terms of what type of instrument, I don't want to say strategies, because that sounds maybe like I'll be giving all the answers, but what type of instrument and maybe some approach in terms of policy that we've been following that we've seen useful. I guess needless to say, hedging does not necessarily sit as an isolated thing. It comes out of the broader risk management for the company. For a company like Thungela, where we receive revenues in hard currency, I think now it's probably 100% of revenues in hard currency, and conversely, the spend is in Rand. So that mismatch is what lends us in the hedging world. So then it's given that when you perform that risk management process, currency risk will feature significantly and will be something that stick out that you will have to, as treasury and also as management, you definitely have to address. And in terms of addressing it, what we'll be seeking to achieve, we'll be seeking to manage that currency risk, foreign currency risk volatility, and protect to some degree of cost, the earnings and budget objectives that we would have set out, and also get some level of predictability in terms of cash flows. And maybe sticking with volatility, for commodity exporters that are in developed markets, have a different problems compared to us. We're seeing it with some of our operations in Australia, where they don't have as much volatility of the currency like we do see in South Africa. So when you're in South Africa, actually I would say emerging markets, it's a different kettle of fish when it comes to the volatility. I mean, to probably be fresh in most people in the room's mind, in most minds, for people in the room, that last year, April, we've seen the Rand hit the weakness levels of 1993. And fast forward to earlier this year, we've seen it breaking below 15 rand. Below 16 rand. And I mean, that's within a space of 12 months. So it's, if you have 100% exposure of your revenue and you experience a 3 rand movement, you have to ask yourself, do you sit on your hands and hope and pray, or do you maybe use hedging to some degree, achieve some protection? So that's where the volatility element is quite key for us. And I guess the question might be why you're not doing the same on input cost, which is, leads me to my second point, specifically diesel. Thungela, to be common knowledge, that we have open cast operations, which consumes quite a significant amount of diesel. But when we are assessing the diesel risk, while we continuously look at it, so far we haven't been active in that space for a number of reasons. One of them being, with diesel, what we've seen is that there's a natural hedge between our kind of commodity and the diesel. So when Brent go up, coal is likely to follow. Often when there's a weakness in currency which will affect the diesel cost, we get the benefit on the top line. So that hedge has sort of provided some cushion. But another thing that we've grappled with specific to diesel, and you could argue explosives and all other input costs, but in this case just diesel, is that we find it difficult to pin down the basis risk. What do you hedge? Do you hedge the brand? Do you hedge the currency? And so that scenario often sort of lead us to maybe not doing much or just leaving it as is. That's why we haven't been active with regards to diesel. But also, it doesn't feature as significantly. Yes, it does creep and create cost creep in terms of our input costs, but it doesn't feature as significantly compared to what I've mentioned with FX. And maybe moving to the last point, in terms of what have we seen, what type of approach and instruments that we've seen useful. I think all what I've said in terms of hedging would be, I guess, given that should be underpinned by sound hedging policy with defined objectives. And when I talk about defined objective for us, it's to be clear that the purpose we'd like to hedge is to protect downside risk. The aim is not to suddenly turn treasury into a profit center, because we've realized that once you do that, you could find yourself where you're introducing different kind of risks, including being speculative and being timing risk where you try and time the market, and which is certainly the space that we wouldn't want to find ourselves playing in. So defining those objectives in the treasury are very, very helpful. And also having clarity in terms of a hedging ratio. So what is it that you'd like to take exposure on? So what we've seen helpful is that multi-layered approach, where on the front end of the book, you would have a lot more exposure, and then obviously that will taper down as you move out the period. And that obviously allows you flexibility as the market changes. You are able to pivot because you're not fully committed in the market. And then what we've also, in terms of instruments, the key thing really is simplicity is often our friend. So simple instruments, I think they work better. Yes, we often look at value, but if you don't understand it, it's ideal that you don't use it, because you might find yourself in difficult positions. So we often like simple instruments, but would obviously derive value. So we use multiple, from FECs, target forward redemptions, collars, geared collars, options, etc. So we're quite open, but we often lean towards more simple instruments. And often, with most people in the room will know, coming from the banks, different instruments derive or show different value at different times. So that will also be a huge factor for us. And then obviously the last point in terms of policy being the timing. How far out are you willing to go, or does your policy, or have you set out your policy to go in terms of hedging? I think I'll just pause there.
Okay, thanks. A few questions. The one point you make is that the intention is not to create treasury as a profit center, because that could introduce, uncertainty and risk that you, as a corporate, don't want to experience. But what I'd be curious is to understand, how does one measure the effectiveness of Treasury and the implementation of policy, hedging policy? So how does that get measured? And is there, and this could be a contentious question, is there a mechanism of remuneration on the effectiveness of Treasury's behavior from a hedging point of view?
So to measure effectiveness, one area would be the ratio. So our policy sets out the ratios in terms of what level of coverage you should have obtained at a given period. That's the measure. Fortunately, I think for me and my bonus, the the measure is not in rands and cents to say you need to have achieved X. However, there is a linkage to budget. Once the budget has been set out, and often the budget is set out on the basis of the guidance of what we foresee the currency or the projections from the financial institution. So it's not Wilfred thinking, well, the rand will be 19 next year or whatever. It's on the basis of what the forward rates that we get guided by the market. Once that guidance is out, it's at that point that we start talking about how do we hedge a couple of months out. And that's the time where we'll be having conversations with the like of Riaan from TreasuryONE in terms of, okay, what structures do we start getting into place, etc. So if we hedge the rate aligned to the budget and the right ratios, we would have achieved our objective.
So let me just, for understanding there, so you sit at the beginning of your financial year.
Correct.
Okay, so you sit at the beginning of the financial year, you get the bank's forecast. So all those economists that are finding it easier to forecast than actually trade, you use those forecasts. And your executive take those forecasts and they use those to determine a budgetary rate that you need to try and achieve for the year. Spot. Okay. I've always, it's one of the hardest things that I've struggled with over the years, because in the organizations that I worked with, I saw our economists change them every month, every second month, those forecasts, depending on how the market was behaving. And it didn't have any, they didn't have any consequence to changing their forecasts, as opposed to you guys who are using those. So I always try to understand was, when you sit at the beginning of your year, the easiest instrument and the most market-quoted instrument out there would probably be the forward rate. Simplified forward rate, not forecast, nothing like that, but would be to take the forward rate and build a budget, an annual budget off of the forward rate. But the forward rate is usually well below what the forecasts are. So I know why the execs all fall in love with the forecasts, and they make it almost impossible for treasury teams to achieve those, unless there's a, from an exporter point of view, unless there's a blowout. But one thinks that it would be simpler if they used physical rates that can be achieved as of today for the next 12 months and said, there's our budget. Now let's manage against that for the 12 months. Any reason why they don't do that?
The simple reason with the not using forward rates is that, as you know, it's biased to spot. So, and the budget tends to be a process. So if you want to take a spot, at what point in time do you take the spot? So that's why our budget is normally concluded around about October, November. That's why at that point, we rely on the forecast and use obviously the forecast along with the analysis to try and to derive what we think would be the practical rate. Why I'm saying practical rate, we're not trying to, you could put any number. The reality is, will that number be achievable? So we try and look and be, at some point we're even a bit on the bearish side, and just so that you build some I don't want to say conservatism, but to ensure that you're not finding yourself with a budget that from day one, it was unrealistic. So we don't use the forward rates, we use the forecast. But yeah, so far it has been useful.
Look, I think if one just simply looks at the performance of Thungela over the last couple of years, with how the exchange rate has behaved, your hedging has certainly created positive constant cash flow. So there's no doubt and no question whether you achieved the forecast or whether you just maintained an active dynamic hedging policy. It's worked in the favor of the shareholders. You've created value for shareholders by using that approach for the last few years, definitely.
No, absolutely. And I would like to credit the market for that, so that when the flip side happens, I can go back and credit the market.
But that's when you need, that's why those instruments that give you participation are so critical.
Absolutely. We've been fortunate. We've been very fortunate. Thanks.
Okay. We now go to Riaan, who had one of the elements of his portfolio was looking after treasury. And that's a treasury that didn't do any hedging, not on the input side or on the revenue side. And great to have your insights as to why that approach. And, do you could actually give us an opinion now because you've just left them as to whether you thought it was the right approach.
Thanks, Peter. Just checking here if everyone can hear me. Good morning, everyone. Thank you. I thought I'll just spend a minute or two just giving context around DRDGOLD. Maybe for those of you who don't know the company that well and you get asked tonight at the dinner table, what did you do or what does DRDGOLD does? Then you can answer quickly. So just briefly, so it's the longest continuously listed company on the JSE, so they can't hear me. So there's something wrong. I'll grab this rather. Good morning. Just testing. Okay, does that sound better? Excellent. Let's work with this. So what does DRDGOLD do? So it's the longest continuously listed company on the Johannesburg Stock Exchange. 25 April this year, it was listed for 131 years. So, and again, I just want to say that because part of our strategy is survival. If you can think about it, you must stay in business. And that as a topic we can talk about. Because just remember, the gold price wasn't always maybe as high as it is right now. It's like 10, 15, 20 years ago. And then we take waste, old mine dumps, exclusively. We process roughly 25 million tons of material a year and produce roughly 5 tons of gold. Our purpose is to reverse the environmental legacy of mining. So taking the story of Joburg, all the mine dumps that's lying as waste sites, trying to reprocess that and deposit in a responsible way on a new tailings dam. So it's very much for how long can you mine. And then just an interesting fact, if you think about margin, and we can talk about that, you hedge for margin. We only recover 200 parts per billion. So at 0.2 grams per ton, DRDGOLD. So from a margin point of view, it's very marginal. And at points in our history, obviously very close to break even, that we can't sell. Okay. Why don't we hedge? And if I can talk to the last 11 years, and with some exception, and I think that'll be an interesting discussion point, Peter, when did we actually hedge for a very small portion of time? So we believe our shareholders want exposure. We're a South African gold company that has a strong environmental purpose that we want to achieve. So we believe they want exposure to both rand dollar volatility and also gold exposure. And if we are able to give them that, we believe shareholders would invest in DRD. There's maybe other companies that have hedging policies, and they can consider those companies if they want. But as a natural full exposure to the gold price, some portfolios or some shareholders want that. So what can we control? Clearly, in all the discussions, rand dollar, gold price, I've always asked this question, and he's right. So why do we have a consensus, and why are we always wrong? Because he says if you ask someone a consensus price, it's not because they don't know, it's because you just asked them. And that's why they told you. It's not because they know. You just asked them the question. So in all of this volatility, what can we control? And that's cost. And you think about the DRD in 25 million tons a year, it's cost per ton. That's what we must focus on. and margin will follow. So when did we actually think about hedging? So in 2019, when we bought the Far West operation from Sibanye-Stillwater, and again, the numbers sound almost unreal, but it's only 7 years ago, we had to borrow some money to go and build the first phase of that Far West operation for 300 million rand. And at that point of our history, our margin was very tight. So we had to borrow money. We were building an operation, no cash flows in that 6 months, say, period. So in that period, we did take out a zero-cost collar, only for 9 months, to make sure if the interest payment comes up, we want to stay in business. We don't want to go under, because we can't afford a debt payment or an interest payment. And can you believe it? Our zero-cost collar was between 565,000 Rand a kilogram and 609,000 Rand a kilogram 7 years ago. Can you believe it? But only for 9 months, because we want to secure once the cash then started to flow in that operation. Same back to our policy, we want to give our shareholders full exposure. And that has worked magnificently well for us from that point forward. What is our backup then? Because as you may know, we invested heavily in solar. And the reason why? Because that is our cost hedge. How do we control the cost of electricity? Because that's the one we can control. Let's try and invest in solar. It's green energy, so that's a cost driver. But we've invested more than 10 billion Rand to grow our Far West operation. So don't we need some price protection for that? But our fallback for that was, let's get a facility in place, a long-term facility, that if the gold price falls, we can access that facility in the meantime. But we still want to give our shareholders full exposure. And that worked brilliantly. DRDGOLD has paid a dividend for the last 19 consecutive years, focusing on cash generation and controlling costs. Peter, but let's leave it at that. Hopefully that clarifies, and hopefully that will trigger some questions.
Thanks for that, Riaan. So the statement that shareholders want exposure to gold rand, and that's why they buy DRDGOLD, because they know it's unhedged and it gives them that. I grapple a little bit with that concept, because if I, as an investor, want full exposure to gold rand, I'm going to go buy an ETF, because that gives me that full exposure, all right? And it takes away any production issues and production cost. I can, and it's very simple to go and achieve that. I get the sense, though, the investor that buys the DRDGOLD, they get the leverage effect. Your costs are fixed, so you've got fixed costs, and when the gold rand price starts to appreciate, you get you pretty much get double the return than what I would be getting in my ETF. Is that correct?
That's it. Yeah. So it's very sensitive to margin. Yeah. So, and that's what we've seen from our share price at R1.70 in August 2016 to over 50 Rand, reaching 60 Rand at some point. So it is that margin. Boost.
So simply put, if gold rand, if I had an ETF and gold rand went up 10%, I've gained 10%.
That's right.
On my ETF. Yeah. Probably I would see 20% on a share price increase of DRD.
At least, and you get a dividend if we generate that cash and it's available, and we declare the dividend. Yeah.
So my question, though, is, because I think that's fantastic, but I still grapple with, why don't you at least hedge? Because you talk about, you create efficiencies by cost management. Yeah. Okay, and the fact that you've gone solar is a way to manage costs as well, which I think is fantastic. I think from a production point of view, you probably are one of the so-called lowest gold producers in South Africa. You've got efficiencies there, etc. But your entire production cost is rand-based. Mm-hmm. And I still don't understand why you wouldn't want to, at least on a consistent basis, hedge the amount of currency gold rand revenue to cover your costs and your annual costs. And the reason being is, I still, as an investor, I wouldn't get the full 20%, but I would still get maybe 15% or whatever, all right? So we're upside participation, beating the ETF, but I know that when the gold rand price turns, I don't get the full impact. So that would start to make it look attractive.
Yeah. No, and that's right, Peter, and Henny and Wichard and team at TreasuryONE can attest. It's not that we haven't thought about it. Exactly.
I'm sure you
those.
have, yeah.
And it's this, yeah, and we have, and we're still thinking, I'm sure the board is still thinking about that. And it's what Wilfred has said. For example, if I look back, often I can see points in time for me where we could have. He was calling April 2025 last year. If the rand at 19, also the US dollar got spiking, you probably could have gotten a zero cost collar up to 3.5 million rand a kilogram, with 2.5 million floor. Why wouldn't have that been a good instrument? Maybe it would have at that point in hindsight. It's just philosophy around people thinking they can hedge margin. We don't want that. We want the focus on costs and to say you can never buy a margin. And we can go back in history. There were times, I think 2017, where we made losses. It's of course it's possible, but we just believe there's enough robustness in the cost model and the operating model to not be necessary for that to do. Will it be the same going forward? Maybe not. And that is the challenge around, because the objective is we want to mine for as long as possible. And at what point, from a survival point of view, do you almost want to hedge that? And maybe that changed, but at the moment, we don't believe that is required.
Okay, thank you. I am conscious of time. We've spoken hedging here. We've spoken DRD that doesn't hedge. What hasn't come into the conversation, and I don't think it has been part of your processes, is making a call on do I hedge or don't hedge, or I hedge, but I'm worried about accounting and hedge accounting. I don't think we've had it with our panelists, but we've got an expert in the room who's going to talk to us about it, because I know it, other corporates here, it certainly is one of the determining factors when they're making decisions on hedging or not to hedge, what instruments to use. And I know it's a passion of yours. And I think you also probably have a passion on whether clients should be hedging or not. So I want to, we want to hear from you and share more than just accounting thinking. Share some of your fundamental thinking around markets and management of market risk. And over to Kev.
Thank you, Peter. Just taking at the back, the mic's okay. All right. So yeah, it's certainly not an accounting lecture, so don't sit back and hold on for that. I think a key thing for me is maybe upfront just to distinguish between the concepts of hedging and hedge accounting, because there is a distinction point in terms of you can hedge and you can be economically hedged, but in certain of these circumstances, you get certain accounting mismatches that come, particularly, for example, on the import side, where you may be hedging orders or imports that are coming in that maybe haven't hit your balance sheet or hit your financial records. So you have this distortion in your accounting records between your underlying hedging instruments and what's coming through on your hedged item. Those are the circumstances you want to go down a formal hedge accounting route, because what that achieves ultimately is an alignment in your accounting and removing the volatility in your accounting records that gives you the same effect you were looking at from the economic side. And I do think that's an important thing to understand to make that decision as to whether go down a formal hedge accounting route. Because the challenge that happens is when you go a formal hedge accounting, in terms of the accounting standards, it becomes very formalized in terms of you having to actually document your hedge accounting through documentation, set up hedge effectiveness models, and then constantly monitor. So it does become a process to operationalize within your business, and often where that is neglected or that isn't really thought about properly upfront and planned before you go and pull the trigger, this is what causes the issues down the line and the frustrations when your auditors come in and the result that you're expecting is not what comes through the financial records necessarily. Look, I think as a CEO and CFA, I'm often the realist in the room and the person that has to give the negative news and the risks and the challenges. I think on the flip side, though, the changes in the accounting standards over the last 5 to 10 years in terms of movements from an IAS 39 to an IFRS 9 has really made hedge accounting easier. Because what we've seen is a move away from hard rules-based hedge accounting principles to more principles-based. And it moves a lot more to what Wilfred was talking about in terms of defining a hedge ratio and hedging against the ratio, and then for your accounting to basically follow and measure how effectively you've been able to achieve that ratio you set. So it becomes a lot easier. The more experienced accountants in the room that might be here might remember the bright lines, the 80 to 125% effectiveness that you had to achieve in the old hedge accounting standards. Those are gone under IFRS 9, so there's flexibility. But what has replaced that is a much closer link between defining your hedge accounting and your risk management policies and disclosures. So again, to both what Riaan and Wilfred have said, it's so critical for you as an organization to define very clearly your risk appetite, your risk policies and frameworks, and then have the accounting as the mechanism to achieve those. But I think to avoid surprises and avoid some of the challenges, it's really about consulting and defining out your hedge correctly at the start, put in your documentations. You can easily model what these hedges can do over time, and locking that down before you go and trade out and lock in your prices so that you actually get the accounting impact at the end.
Thanks, Kev. So I think what I'm hearing loud and clear is that it's a lot more flexible from an accounting point of view now, but you got to do the work. You got to do the pre-work and set it up initially. So the kind of products where you want to have that insurance, but you want participation. At times it might not look like a perfect hedge. That you've got to do upfront with your auditors, define it, put it in policy. Going forward, then it makes it a lot easier, and you don't have any surprises to, for your CFO, etc., when you are pulling the trigger and putting those hedges on book.
Yeah, correct. And I think that is key. I think it is important to look at some of these instruments. I concur with Wilfred in terms of keeping it simple. I think from an accounting side, that makes the hedge accounting a lot easier. Things like breaking down your hedges as granular as you can. Yes, you can macro hedge, you can dynamic hedge, and really try and bulk up your underlying hedged items or orders and take a single FEC as an example. It does pose challenges over time when you're actually accounting where that link starts breaking because some of your orders maybe got pushed out or amounts varied. So practical tips, to think about is, defining your hedge documents and programs in a way that you can tailor and update, and then trading your hedges in a way that you can get matches at a more granular level. I think some of the instruments become challenging to get into the hedge accounting model, particularly where there is optionality. particularly on some of the import hedges around, for example, diesel, and matching that with a crude hedge on the other side. So when there's different grades and different areas, particularly in the commodity space, it can pose challenges to actually achieve the result from a hedge accounting side. So again, to have thought through that up front, kind of considered that, I think allows you to get that result. And maybe the last point, Peter, is stakeholder management here, in that you might know what you're trying to achieve economically. I think I've seen in a number of instances, boards and outside stakeholders don't always understand and appreciate what hedge accounting is there to achieve. And really it's there to achieve, stability and remove volatility in your accounting records, which is fine when you've hedged fair value losses and everybody's happy. But when your hedges have turned and your hedge accounting is now reducing the fair value gains that you could have had, stakeholders look at that and I'm sure put a lot of pressure on the treasurers. So, I think it's that education factor saying, well, before we get in the program, let's link it to the risk objective. Let's make sure everyone understands what this looks like, in a rand weakening and in a rand strengthening position.
Thanks for that. I think probably the biggest challenge is when you talk about some of those funky products is getting the granular details out of the banks. They pride themselves on their IP.
Yeah, I think it's about understanding the payoff profiles. It's understanding the underlying accounting and what's obviously driving the instruments, and where the instruments have been
That's a bit
packaged,
tongue-in-cheek.
No, sure. But, packaged instruments are where it becomes difficult, and challenging. I think it's make sure you fully understand the package and how it breaks up.
Okay, thank you. Before we wrap up, any questions from the floor for any of the panelists? Henny.
Hi, it's Henny. Can you hear me? Okay. Kevin, I think for you, can you explain to me the hedge accounting purpose? I mean, if you sit in front of a corporate and the debate is, should we hedge account or not hedge account? So what rationale, if I was the CEO or the CFO or the treasurer, what debate would you have with me? What's the route we have to decide on hedge accounting? I know the basics, but it would be nice to know from your perspective about, because we've spoken about lots of hedging and not to hedge, but obviously hedge accounting is a different element of hedging. I would just like to know your opinion. Explain to me, the school version of hedge accounting.
Thanks for the question, Annie. Maybe the easiest way is probably through an example. And, let's take an importer scenario where you're importing products in a foreign currency. As you place that order, from an accounting perspective, you don't recognize anything in your accounting records until that item is actually delivered and you raise the creditor on the other side. But from an economic perspective, you're exposed to that foreign exchange variability from the time you've placed that order price at 16 Rand to when the thing lands and you then have to raise the creditor, which might be Rand has moved to 17 Rand. So you're exposed to that volatility and loss there. So what the hedges obviously do is you take the hedge to lock in your rate at the 16 rate. From an accounting side, because you've taken the hedge, the FEC, you need to account from that from the moment that you trade it. So you've now got fair value volatility as the rates move from 16 to 17. On the hedged item side, so on your order side, there's no accounting on there until it actually hits your balance sheet once it's been delivered or your credits is raised. So you now effectively have volatility on 16 to 17 Rand on the one side, but you don't have the volatility or the offsetting profit or loss on the other side. So what hedge accounting does is during that period, it actually brings on a firm commitment or it brings on an asset or a liability onto your accounts that will then remeasure and create that offset link to your underlying FEC or your derivative. So from an accounting side, you end up flat. You end up reporting the economic result that you've actually set out to achieve. And the only mechanism that you can do it is through actually formally designating hedge accounting, which gives you the permission, shall I say, in terms of putting on this hypothetical profit or loss during that period of order. If you didn't have that, yes, you would have been economically hedged, but during that period, and as the time that your goods land on board, you would then basically still get your products at the price you've hedged. But in that period, that 2-3 months while it's being delivered, you've got big noise in your income statement, which gets taken away. Hopefully that simplifies it a little bit.
Thank you. Good morning. My name is Siabonga from Sandra. 2 questions. First one, Wilfred. In terms of not hedging your input costs, does SARS have anything to do with it? It's a safe space, you can be honest. Right? And to George, the departure of the UAE in terms of leaving OPEC, what's potentially the impact of that? And are we seeing OPEC surviving this entire, I don't know, turmoil? And what's the impact if it collapses?
Thanks for the question. I need to check if the camera is on or not. But yeah, on a serious note, no, SARS wasn't a consideration. It was purely a risk management outcome. When you're assessing the risk, the conclusion was there is that risk, but like I said, the natural hedge helped. So we realized that actually there is an offset, and a decent offset for that matter, so we're happy to live with that risk. And secondly, we just struggled with the basis risk, like I said. We were unsure. You look at the brand, do we go and hedge the brand? Do we go and look at the rand as well? Which then create complexity, which we're not comfortable living with. Does it mean we'll never hedge that? No, it's a continuous consideration. We could arrive at instances where we look at hedging diesel, for instance, or explosives for that matter.
Yeah, and your question on OPEC and the UAE indicating that they're going to depart. So there are a few subplots to what's going on there. Some of it geopolitical, some of it market related. Some of the geopolitical considerations that you need to think about, it goes further than just OPEC. The question expands to BRICS as well. So within BRICS, Iran was part of BRICS, Saudi, UAE, and a couple of others, Russia, all part of BRICS. And all of a sudden, you've got one BRICS partner attacking other BRICS partners. And the UAE in particular has borne the brunt of the Iranian attacks. So the UAE always wanted to, if you had a look at their objectives over time, there's a policy that they were following, which is called D33. You can go and read up on it on the web. But they wanted to become the central financial capital of the world. So Dubai wanted to become the central capital of the world. Obviously, Abu Dhabi, right next door, is the main oil producer of that particular region. So combined, there's a very powerful force there, not just in terms of oil production, but also in terms of it being a financial hub and etc. It has wanted to be more autonomous in the way that it gets to decide its future for a few reasons. Dubai on the financial front, but Abu Dhabi on the oil production front. And I think that they've utilized this opportunity as a really good, justifiable reason to be able to chart their own path. They also want to be able to try and recoup some of the damage that's been done to their economy, and they feel that they would be more dynamic and be able to do that potentially outside of OPEC. It allows them to free up and target greater production quotas, for example. They're not going to be hampered by that, and that in itself is going to be an interesting dynamic that unfolds in that region. Does OPEC hold together? I mean, it's an interesting question, and it brings a couple of other subplots into play as well. So the US, for example, over the past decade or so has gone from oil importer to a significant oil exporter, but they went and got hold of Venezuelan oil as well. The objective there is to ramp up that oil production significantly. The US geopolitically wants to regain some control over the oil markets and reduce some of the dominance of OPEC, which is ultimately a cartel. And I see one of the questions that popped up here: who determines the oil price? What happens if OPEC falls away? As a question allied to yours. So we mustn't just think of these things in isolation. There's a big power play that's unfolding at the moment, and the US is very central to it. So having ramped up its production, having secured Venezuelan oil, which has got the biggest reserves in the world, and having the refineries to refine Venezuelan oil, it now controls where that oil can go. So naturally, where China was the biggest importer of Venezuelan oil, the US now has a say in how that all unfolds. If you wanted to become more friendly, if you wanted your relations with the US to improve, as UAE, you would probably do exactly what they've just done. And they've probably done that in the hope that they secure some favor from the US and some protection in terms of what's going on at the moment. So what does that mean for OPEC? Well, it does undermine OPEC. There's no question about it. The UAE move will undermine OPEC. And when you combine that with what's going on in America and Venezuela, you begin to see that there's a far bigger picture that's unfolding here than just OPEC on its own. So OPEC, I think, is probably just still going to be around for a while. I mean, you've got some big oil producers that are still there, dominated by the likes of Saudi, for example. But does it get undermined? Absolutely, it does get undermined. How does the oil price get, how does it get arrived at? How do we see the oil prices on screen? That's a free market. It's traded worldwide. It's not determined only by OPEC. OPEC obviously has a significant influence by virtue of the quotas that they can push in and out of. But the stronger the dynamic from the US, Venezuela, and now UAE that is free to produce more than its current quotas, well, you begin to understand that the dominance in setting pricing from an OPEC perspective reduces. And I think that's probably quite good news for the rest of the world. It potentially also, once we get through this crisis, helps eventually, once we get over the operational issues, probably helps oil prices come all the way back down again.
It dilutes OPEC's impact to an extent.
Yeah.
They don't determine price, they determine the volume of production. That's exactly it on a daily basis, and that's how the cartel has operated. So this actually, in the long term, probably work out better. And the fact that you talk about the US and Venezuela, the increase in production happening over there is going to have a greater dilutionary impact on OPEC as well. Yeah. That I see there is one other question there. Will it affect the petrodollar system?
Again, that's not a straightforward answer. Yes, it does in a sense. If anything, it might strengthen it. But against that, you've got, as I showed in the one chart, you've got a number of the central banks that are trying to diversify away from dollar holdings. So you've got BRICS that are actively pushing to shift away from the dollar, but the dollar system is well and truly entrenched. I mean, it's still, the bulk of global trade takes place in dollars. To usurp the dollar is going to take quite some doing. I was in the UAE. I was in Dubai a couple of years ago, and I was privy to some really interesting conversations about this exact point, this petrodollar and the future of the dollar. And at that point in time, BRICS Plus had just come around, and BRICS Plus had included a number of smaller oil-producing countries, and one of the alternatives to a dollar that was flighted at the time was a digital currency backed by oil and gold. Which made that a very interesting proposition, because you had a number of these oil producers in OPEC, and you had some of the BRICS countries actively purchasing gold, selling US treasuries and actively purchasing gold. So that made that a very interesting proposition, but given what's happening at the moment, I'm not so sure that BRICS countries are as friendly towards each other as they were. And I don't know that they're as coherently structured as one might think. So I think, petrodollar system, I think is still going to be around for a while. And I don't think the dollar gets usurped particularly quickly, but are there active efforts to do so? Definitely.
I see we got someone at the back there.
I see there's another question there on statistical analysis of rand valuation. How do DM currencies compare against each other? I mean, we would have to obviously run that statistical. We've got those statistical models for you. I would have to bring that up and show you what that looks like, but you can absolutely run the statistical model across any currency pair you wish, and it will give you that same bell-shape curve to give you a sense of where that valuation sits.
Yeah, thank you. Just two issues. One is we talked a lot about pricing risk. What didn't come up is liquidity risk. And in a lot of the African markets, you'll see that NDFs are non-deliverable, trades, but forward trades that have delivery coupled to them can actually secure liquidity as well. So if you buy a deliverable forward in dollars in some of these African markets, for example, you get that benefit in managing liquidity risk as well. And I think you could get that in
Thank you. I'll just quickly repeat the question if everyone didn't. So if we have to change or think about changing from a non-hedging policy to something different that Peter also raised, what will our thinking be like? And I can tell you, reflecting on the, obviously since we embarked on the very big phase 2 Far West development of 10 billion rand, so at some point, and again, Wichert and Henny and them would know, we were trying to understand at what base price wouldn't we incur debt, because that's a big part of the DRDGOLD story as well. We don't have debt. Again, that can be criticized to say, well, you're not leveraged enough or growing quickly enough. So at some point, that was part of the discussion. What is the floor price? If you think about a zero-cost collar instrument, rand, gold, to not incur debt over the next couple of years. Again, we were fortunate, and that was the consensus price I referred to that I asked Henny about. It was always more than that. So we were able, as a company, to generate more cash than what we forecasted, even at that level. But then it is back to Peter to say, yes, it buys you some insurance at points where you may have difficulty in production, and that is very much part of South African risk. Things go wrong. We are a high volume operation, obviously operate 24 hours a day, 365 days a year. So I think you can go into that conversation to say, yes, it's an insurance policy, it doesn't cost you much. You may give up some upside if the price continues to go, but you'll never hit your full production. And then it's similar, I think Harmony has a 36-month rolling between 10 to 30% production. But then for me, it's not a once-off. That's what I personally like about that policy. Again, the shareholder understands that. It's a rolling and it's always a part of the production, where ours is nothing. So maybe at some point, yes, you can convince someone in a different gold market, but it's so tempting at the moment to not do that, and we don't have to pay off debt, and that phase 2, Vision 2028, is coming up, more production in the next couple of years. So, yeah, from our perspective as an outsider now. Don't change it, but never say never. We want to mine as a company for as long as possible. But thanks for the question.
Any more questions? All right. Just a quick thanks to my panelists here. I think we've had a pretty good conversation this morning. I think we've shared some thoughts that will obviously be thought about and taken away. I think some of the things, though, that I was thinking about as you guys were talking and we were having challenging each other, etc. What we're doing up here is we're not suggesting let's see some knee-jerk hedging happening. Absolutely not suggesting that at all. We're suggesting, and you can hear it here, is that policies, whether you look at your treasury policy, your hedging policy, there's no better time than now to be reviewing those. And I think the word is review. And the proper homework needs to be done with any decisions, new decisions that want to be made, or even old ones that need to be refreshed, is, get your auditing team in, get them having a look, give you opinions on the accounting side, do all of that work up front before you decide to take advantage or have a knee-jerk reaction to what's going on in the world. You don't want to create internal turmoil in your company because you've convinced them that hedging or not hedging right at this exact moment is the way to go. I think proper homework needs to be done before one does any of those changes. Thanks, Artemis.
Peter, thank you very much. You've actually encapsulated exactly what we heard. First about the economy, not hedging, and then how to account for it. And thank you very much to the panelists. And thank you to everybody here for attending. We hope to see you at our next breakfast. And if there are any further questions, please say. There's lots there, there's a lot of coffee, tea. Do stay and just discuss with everybody what we've just heard. So on behalf of the association, thank you very, very much. And thank you also to TreasuryONE.